Imagine a company, right? Like a massive tech company, just taking an axe to its middle management.
Oh yeah, just completely gutting the org chart.
Exactly. Slashing the management layers, freezing the overall headcount, and then, and this is the crazy part, handing over huge chunks of their core software development to internal AI bots.
Which, I mean, in the traditional Silicon Valley playbook, that is a massive red flag.
Right. It's a recipe for catastrophic product failure, or at least, a massive slowdown in shipping new features.
Oh, for sure. You'd absolutely expect the system to just buckle under that kind of sudden structural vacuum.
But for Block Inc., in the first quarter of 2026, executing that exact playbook resulted in a 56% explosion in operating income.
It's wild. It completely upends the traditional scaling model, which for the last decade has essentially just been hire as many engineers and product managers as humanly possible and figure out the unit economics later.
Right, the classic growth at all costs mindset.
Exactly. But Block is proving that era is entirely dead. We are now firmly in the era of operating leverage.
And that is exactly what we are tearing into today. Welcome to a special Talk Ticker style deep dive.
Glad to be here.
We are taking the Q1 2026 earnings call transcript from Block, which, a lot of people still just think of as Square or Cash App, and we are putting it under a microscope.
Yeah, we're getting into the weeds today.
We really are. The mission is to do a data-forward analysis. We're pulling the exact figures from Jack Dorsey and his CFO, Amrita Ahuja, and stripping away all that dense Wall Street jargon.
Because we want to figure out what this actually means for you, the listener.
Right. Whether you are holding this stock, maybe considering buying it, or just trying to understand where the whole financial technology sector is heading.
And honestly, the broader macroeconomic environment right now makes these numbers even more critical to dissect.
Oh, totally. With sustained inflation and everything.
Yeah, consumers are feeling the pinch.
Yeah.
And the banking sector has been incredibly cautious about lending. So when a massive fintech player posts these kinds of growth metrics, you really have to look under the hood.
You have to ask, is this genuine, sustainable market share? Or are they just, pulling forward future growth through really risky lending?
Right, which we will definitely get into.
So let's start with the hard data drop, because Block really came out swinging in Q1.
They absolutely did.
The headline number that Wall Street immediately reacted to was gross profit, which hit $2.91 billion.
Which is a 27% increase year over year. Massive.
But the profitability metrics are where jaws actually dropped. Adjusted operating income, or AOI, hit $728 million.
And that's that 56% jump we mentioned at the top.
Right. Representing a 25% margin, adjusted EBITDA reached an even $1 billion, and adjusted diluted earnings per share, the EPS grew 52% to 85 cents.
I mean, the disparity there between the top line growth and the bottom line growth, that is the entire thesis of this quarter.
It really is.
But to even understand the top line, we really need to clarify why Block's management and, any analyst worth their salt focuses almost obsessively on gross profit rather than just total revenue.
Yeah, let's break that down for the listeners.
Yeah.
Because it can be confusing.
If you evaluate Block like a traditional software as a service company and you just look at their total revenue, you're going to completely miscalculate the health of the business.
Right, because of the pass-through costs. I always like to think of traditional payment processing like a massive drop shipping business.
Oh, that's a great way to put it.
Right. Like Block facilitates a transaction at your local coffee shop, and the total volume of that transaction registers in their system. But a massive cut of the fee they charge goes straight to the manufacturers of the financial system.
Right. The Visa, MasterCard, the issuing banks.
Exactly. They get their cut before Block even sees a dime of actual margin.
That drop shipping analogy is spot on. They are the interface, but they don't own the underlying rails.
So total revenue just looks artificially huge.
It's incredibly misleading. It's inflated by all those network fees they are legally obligated to hand over. So gross profit strips all that noise out.
It's the real money.
It is the pure, unadulterated cash that Block actually gets to keep. It's what they use to run their own business, fund their R&D, and drop to the bottom line.
And growing that pure usable cash by 27% year over year to nearly $3 billion in a single quarter, That is a massive signal of underlying utility.
It really is.
Yeah.
And when you look at where that gross profit is coming from, it's essentially a tale of two very different ecosystems.
You have the consumer behemoth, which is Cash App, and then the merchant network, Square.
And Cash App was the absolute undisputed heavyweight champion this quarter.
Oh, without a doubt. Their gross profit was up 38% year over year.
Which is staggering at that scale.
Square, on the other hand, saw gross profit up 9%, with gross payment volume GPV up 13%.
Right, which smooths out to about 11.5% if you adjust for currency fluctuations.
So you're looking at a barbell strategy operating at massive scale.
Exactly. Cash App is functioning as the high-growth, consumer-facing engine, expanding at nearly a 40% clip, while Square acts as this steady, mature utility, compounding its volume at a very healthy double-digit rate.
But, the tension in those numbers, specifically Square's 9% profit growth versus its 13% volume growth, we're going to need to unpack that when we get into the forward guidance.
We definitely will. There's some accounting noise in there.
But I want to stay on this 56% jump in adjusted operating income for a minute, because honestly, this is where my spidey sense starts tingling.
I know exactly where you're going with this.
Let's just look at the gap between those numbers. Gross profit grew 27%, phenomenal, but operating income grew 56%. I have to play the skeptic here.
Please do. It's necessary.
When a tech company wants to pump its stock price or, hit a specific profitability target for Wall Street, the easiest lever to pull is to just starve the engine.
Right. You fire the customer support teams, you halt the aggressive marketing spend.
You completely gut the research and development budget. And sure, it boosts the bottom line temporarily, making them look incredibly profitable on a quarterly basis, but they are secretly starving their future growth.
It's the classic swimsuit competition diet. You look great for a day, but you're ruining your metabolism.
Exactly. So is Block just starving the engine to generate that 56% income growth?
The data strongly suggests otherwise. If they were starving the engine, you would expect to see customer acquisition stall or product velocity just grind to a halt.
Right, you'd see the cracks immediately.
But instead, we are seeing accelerating user engagement and a massive spike in product shipping. The 56% growth isn't a result of starving the business. It's the result of a fundamental rewiring of their corporate metabolism.
This goes back to that massive reorganization Jack Dorsey pushed through over the last year.
The reorg is the absolute bedrock of these Q1 numbers.
Because they moved to a much flatter organization.
Right. Yeah. They deliberately reduced layers of middle management. The stated goal was to bring the builders, so the engineers and product designers, closer to the customers.
Without 5 layers of approval in between every decision.
Exactly. Dorsey noted on the call that this resulted in a massive increase in the speed of decision-making.
Which, that sounds great on a slide deck, but flatter organization is usually just corporate speak for we laid off a bunch of directors.
True.
So how does that actually translate into a 56% jump in operating income without sacrificing the product quality?
Well, it translates because they replaced all that administrative overhead with highly leveraged technology. They aren't relying on massive teams to brute force new features anymore.
Oh, this is the AI angle.
Yes. They're utilizing a suite of internal AI tools to essentially multiply the output of the engineers they retained. They figured out how to make the engine run faster while consuming significantly less human capital.
The AI piece is huge, and we are definitely going to tear into the exact mechanics of that in a few minutes because they provided some stunning productivity metrics.
Truly eye-opening numbers.
But the fuel for this new, highly efficient metabolic engine seems to be the fundamental change in how Cash App behaves.
Right. It is no longer just a peer-to-peer tool for splitting a bar tab.
Yeah, the maturation of that platform is the real story driving the top line here.
Cash App is evolving into a primary banking interface for millions of people. And that evolution, that is what separates a low-margin transfer app from a highly profitable financial institution.
Let's look at the metrics that actually prove that out. So monthly transacting actives, just the raw number of people opening and using the app grew 4% year over year.
And management noted that this was actually the fastest pace of actives growth in a year and a half.
But 4% is just okay. Where the numbers get truly wild is user behavior. While the user base grew 4%, the inflows per active, the actual amount of money each user is dumping into the app, grew 10%.
And then there's the holy grail metric. Primary banking actives surged 18% to 9.7 million users.
That 18% figure, That is the single most important metric in the entire Cash App ecosystem.
Without a doubt. Because in the fintech world, acquiring a user who downloads the app just to receive $20 from a friend, that's only step one.
And frankly, it's a step with incredibly low lifetime value.
Exactly. If that user just leaves the $20 there and occasionally sends it back, Block makes almost nothing.
They might even lose money on the server costs and customer support overhead for that single user.
Precisely. The economics flip when you convince that user to route their actual financial life through the platform.
Right. When a user sets up direct deposit for their paycheck.
Or when they use the Cash App card as their default payment method for their daily coffee. Or they start using the app to buy Bitcoin or fractional shares of stock. They've officially transitioned from a casual user to a primary banking customer.
And an 18% growth in that specific cohort means nearly 10 million people are now treating Cash App as their main financial hub.
Which creates an immense amount of stickiness.
Oh, yeah. It's notoriously difficult to get a consumer to switch their primary bank account. Once that direct deposit is set up, they are entrenched.
And the primary engine driving this deeper entrenchment, according to the earnings call, is their lending ecosystem. This is the strategic brilliance of how they integrated Afterpay.
We all know Afterpay as the massive buy now, pay later, or BNPL acquisition they made a few years back.
Right.
But the initial thought was that they would just plug it into Square merchants to let people finance larger purchases, right?
Yeah, that was the assumed play. But they've woven it directly into the fabric of Cash App on the consumer side. They've effectively constructed a multi-variable lending platform that touches every point of the consumer lifecycle.
So it started with the borrow feature, right? Which allowed users to take out small, short-term loans.
Exactly. This was essentially designed to cover income variability, just helping people bridge the gap between paychecks. Then they brought in the classic Afterpay post-purchase integration.
Right. You buy something online and you opt to split it into 4 payments after the fact. Standard BNPL stuff.
Right. But the major new development they discussed in Q1, the feature that fundamentally changes the user experience, is the launch of Afterpay pre-purchase, directly linked to the Cash App card.
Okay, this is where we need to explain the mechanism because this totally changes the psychology of spending. How exactly does a pre-purchase BNPL toggle work technically and financially?
So with traditional post-purchase BNPL, the friction happens at the checkout page. You load up your cart, you see the total, and then you have to click a separate button, apply for the installment plan, wait for the microsecond approval, and finish the transaction.
It's a whole process.
It is. But pre-purchase shifts the buying power upstream. Before you even walk into a store or before you even swipe your Cash App card, you can open the app and toggle a setting that essentially says, I want my very next transaction, whatever it is and wherever it is, to be automatically split into 4 payments.
That is wild.
It's a game changer.
You could literally be walking into a mechanic shop knowing the transmission repair is going to cost $1,200. And instead of panicking about your available balance, you just open Cash App in the waiting room, hit the pre-purchase toggle, and hand the mechanic your physical Cash App card.
Yep. And it processes like a totally normal transaction to the mechanic. But on the back end, Block automatically splits it for the consumer.
It entirely removes the friction at the point of sale.
The merchant doesn't need to have Afterpay integrated into their point of sale system. They don't even need to know you are financing the purchase. You are just using a Visa debit card as far as they are concerned.
Block is absorbing all the complexity on the back end.
Exactly. And they noted they are expanding this pre-purchase functionality into peer-to-peer transactions and Cash App Pay as well.
Which provides massive utility to the consumer who is managing tight cash flow. But it also heavily incentivizes them to use the Cash App card over their traditional bank's debit card.
It does. But as an investor analyzing these numbers, whenever you see a massive expansion in consumer lending, especially frictionless lending, like a pre-purchase toggle, the immediate red flag is risk.
Oh, absolutely. If you make it that easy for 10 million people to split payments or borrow money, aren't you exposing the balance sheet to a terrifying wave of default rates?
That's the billion-dollar question. We are looking at a consumer base dealing with inflation and high interest rates. If unemployment ticks up even slightly, frictionless lending can become a toxic asset very quickly.
So how did management address the risk profile of this massive BNPL expansion?
Well, the analysts pressed them really hard on this during the Q&A portion of the call. And the defense Block mounted relies entirely on their proprietary data advantage.
Okay, unpack that.
Because Block sits in the middle of the ecosystem, they aren't underwriting these loans based on a traditional FICO score pulled from a credit bureau.
Which a FICO score is a lagging indicator anyway. It just tells you what a consumer did 6 months ago.
Exactly. Block sees the real-time inflows and outflows. They see the frequency of direct deposits. They see the peer-to-peer network, who you are sending money to and who is sending money to you.
They have a completely closed-loop data lake.
And that allows them to run an incredibly granular, dynamic underwriting model. If your direct deposit misses a week, they can instantly throttle your borrowing limit. If your inflows increase, they can automatically expand it.
And the specific data points they shared on their borrow loss rates demonstrate that this underwriting discipline is actually working in practice. Let's look at those loss rates.
For their newest cohorts of borrowers, so people who have just started using the lending features, the loss rate sits at around 3.16%.
Which, in the world of unsecured consumer lending, 3.16% is already a highly manageable number.
It really is. But the real magic happens as the cohorts mature. As Block gets more behavioral data on a user's repayment habits, they refine the limits. For customers who have been on the platform for 13 months or more, that loss rate drops significantly to just 2.67%.
That is a phenomenal metric. As the relationship matures, the risk profile actively decreases, which means their profit margins on those specific users expand over time.
They aren't just blindly handing out cash, they are building a compounding engine of variable profit based on behavioral data.
And that engine is a massive part of why Cash App saw a 38% gross profit jump.
Yep.
All right, let's flip to the other side of the counter. We need to talk about Square, the merchant side of the business.
This is going through its own evolution.
Big time. Because Square has this legacy reputation, it's the cute little white dongle you plug into an iPad at a farmer's market or a local food truck. It was built for the micro merchant.
Right. But the Q1 data paints a picture of a company aggressively hunting much bigger game. Square is actively pushing up market to serve larger, more complex businesses.
And the gross payment volume metrics show that the strategy is catching fire. Let's look at the segments. Food and beverage GPV was up 21% year over year.
Huge.
GTV from mid-market sellers, which are generally defined as businesses doing over $500,000 in annualized processing, was up 22%.
And Amrita Ahuja explicitly pointed out that these are the strongest growth rates they have seen in those specific, highly lucrative segments since the first quarter of 2023.
And to top it all off, international GPV grew a staggering 35% or 26% if you strip out the constant currency adjustments.
To understand how they are accelerating growth in that mid-market segment, we really have to look at the strategic shift in their go-to-market motions.
Because historically, Square's entire DNA was built around self-onboarding.
Exactly. You're a small business owner, you go to square.com, you order a terminal, it arrives in the mail, and you set it up yourself in 10 minutes.
Which is a brilliant, low-friction model for a single-location coffee shop. But it completely breaks down when you try to land a 50-location franchise network.
Because a 50-location franchise doesn't want to self-onboard. They have complex inventory routing, multi-tiered employee permission structures, and all these legacy software integrations.
They want a dedicated account executive holding their hand, customizing the deployment, and, offering volume discounts.
They demand enterprise-grade sales motions. And over the last year, Block has realized they cannot win the mid-market without boots on the ground.
So they have been building out a global field sales presence across the US, UK, Australia, and Canada.
But building an internal enterprise sales team from scratch is incredibly expensive and slow. The real game changer revealed in this Q1 call is how heavily they are leaning into independent sales organization partnerships.
We know ISOs are the absolute standard for legacy payment processors like Fiserv or Global Payments, but Square historically avoided them in favor of direct-to-merchant marketing.
It's a massive pivot in their DNA.
Let's break down the mechanics of an ISO partnership for those who might not follow the plumbing of the merchant acquiring world.
Sure. An ISO is essentially an independent network of B2B sales professionals. These are local or regional groups that already possess deep pre-existing relationships with merchants in specific verticals.
So they might specialize in selling software to large restaurant groups or point-of-sale systems to multi-location retail chains.
Right. And instead of Block spending millions to hire, train, and manage thousands of local sales reps to cold call these businesses, Block just partners with the ISO.
The ISO goes out and sells Square's software and hardware to their existing client base. And in return, they take a residual cut of the processing revenue generated by those merchants.
It is a highly scalable asset-light acquisition strategy. You are essentially franchising your sales force and only paying them when they actually land a deal that generates revenue.
And the momentum they're generating through this channel is striking. Block announced they now have over 140 active ISO partners operating globally.
And to quantify the leverage of that network, management noted a fascinating statistic. The volume of deals signed purely by ISO partners in the month of March alone equated to the output you would expect from 70 dedicated, full-time internal field sales reps.
Think about the operating leverage in that single statistic. You get the closed-won sales volume of 70 enterprise account executives, but you don't have to pay 70 base salaries. You don't have to pay 70 benefits packages.
And you don't have to lease office space for them.
Exactly. You only pay a revenue share on the volume they actually bring in. That is a massive driver of that 56% operating income growth.
And this strategy is landing the exact type of clients Square needs to move upmarket. They aren't just getting bigger food trucks anymore.
No, they called out specific multi-location wins on the call to prove the point. They highlighted Vert Coffee, a Sea Republic, and a major win with a brand called Cinnaholic, bringing 85 locations back into the Square ecosystem.
You do not land an 85-location deal through a self-serve web portal.
Never. That requires a negotiated contract, customized hardware deployment, and deep integration. The fact that they are winning those deals shows their software stack has matured enough to handle enterprise complexity, and their distribution channels are finally aligned to sell it.
And crucially, they noted that the payback periods for these new acquisition channels are holding very steady at a healthy 4 to 6 quarters.
The unit economics of pulling in these larger sellers via ISOs are incredibly strong, which we will circle back to when we discuss their forward guidance on investment spend.
Absolutely.
All right, landing an 85-location franchise is a massive win, but servicing enterprise clients usually requires bloated customer service teams, extensive technical support, and constant software customization.
Historically, yes.
Yet, as we established, their overall operating expenses went down relative to profit. How are they servicing larger clients and shipping more complex software without hiring an army of engineers and support staff?
That brings us to what Dorsey revealed about their internal AI tools.
This was one of the most heavily scrutinized parts of the earnings call, and for good reason. I am going to aggressively challenge the PR narrative here.
I expect nothing less.
Every CEO in Silicon Valley right now drops the acronym AI into their earnings call at least half a dozen times. It's the new buzzword. It's designed to make legacy companies look like cutting-edge tech firms to bump the stock price.
Yep.
I hear internal AI tools, and I immediately assume it's just a bunch of engineers using ChatGPT to write emails faster. What is the actual tangible proof that Block's AI deployment is anything more than riding the hype train?
It is the correct instinct to be skeptical, but the receipts Block provided on this call are incredibly hard to dismiss. They are not talking about abstract peripheral AI features.
Okay, what are they talking about?
They have deployed large language models at the foundational level of their infrastructure to fundamentally alter the mechanics of how they write and ship code. They discuss 2 primary internal tools, an AI harness they call Goose, and a Slack integrated tool called BuilderBot.
I have to admit, BuilderBot sounds like a Fisher-Price toy.
The naming convention might be a bit playful, but the productivity metrics are staggering. Using these customized tools, which are trained specifically on Block's proprietary code base and infrastructure guidelines, the number of production code changes per engineer is up 2.5 times since January.
Wait, stop. 2.5x productivity from engineers. I have to challenge that number directly.
Let's hear it.
Is that 2.5x actual valuable product features being shipped to the consumer, or is that just 2.5x more lines of code being generated because the AI makes it incredibly easy to bloat the code base with redundant scripts? Because generating code is easy. Generating working, integrated software is hard.
That is the exact distinction that matters, and is why the head of business, Owen Jennings, provided a highly specific, verifiable case study on the call.
What was the case study?
They didn't just point to lines of code, they pointed to a massive feature deployment. They were working on bringing buy now, pay later functionality directly into Cash App Pay.
Okay, a major integration.
Historically, scoping out a project of that magnitude, writing the code, integrating the microservices, and running the quality assurance testing would take 3 months and require a dedicated team of 5 to 6 engineers.
Which is a massive deployment of high-priced resources.
Exactly. But by utilizing Goose and BuilderBot, to handle the boilerplate code generation, the testing automation, and the integration mapping, 2 machine learning engineers, who notably had no prior exposure to those specific internal services, were able to build, test, and ship the entire feature to production in just 3 to 4 weeks.
Wow. Let me process that math. 2 engineers in 3 weeks instead of 6 engineers in 3 months.
It's an order of magnitude reduction in the cost of software development.
If that case study is representative of their broader engineering organization, you can suddenly see exactly how they managed a 56% jump in operating income. They are effectively getting the output of a 1,000-person engineering org from a fraction of the headcount.
And they are expanding the definition of who can actually write that code. The call highlighted that production code changes made by non-engineers at Block were up nearly 60% in April compared to January.
So if I'm a product manager or someone in the marketing department and I notice a minor UI bug on a landing page, or I want to change the flow of an onboarding screen, instead of submitting a Jira ticket and waiting 3 weeks for a backend developer to get around to it, I can just use BuilderBot to generate the fix, test it, and deploy it myself.
Precisely. You remove the massive bottleneck of engineering dependencies for routine tasks. It drastically increases the product velocity of the entire organization.
That is incredible.
But Block's AI strategy isn't just about internal cost cutting. They are aggressively externalizing these AI agents to drive revenue and user engagement directly.
Let's transition to the customer-facing AI then, because they introduced 2 specific agents, ManagerBot for the Square merchants and MoneyBot for the Cash App consumers.
Let's start with the merchant side. ManagerBot is currently live for over 1 million Square sellers. Now, when most legacy companies announce an AI bot, they're usually talking about a glorified FAQ chatbot that sits in the corner of a website and frustrates customers who just want to talk to a human.
Right. Press 1 for store hours.
Exactly. ManagerBot is structurally different. Block described it as a constellation of over 100 localized, automated agents that have the authority to take action on behalf of the seller.
I need to understand the mechanics of that. What does taking action actually look like for a mid-market restaurant using this system?
It means the AI is deeply integrated into the merchant's data streams. Their sales data, their inventory catalogs, their employee scheduling tools, their customer relationship management system.
So it sees everything.
It sees everything. A seller can interact with ManagerBot and ask it to identify the top-performing waitstaff from the weekend shift, or track the revenue differences between new walk-in customers versus returning loyalty members.
Oh, wow.
It can instantly generate forward-looking revenue projections based on historical data. It can automatically draft and send appointment reminders or promotional emails to specific cohorts of customers.
So it isn't just a search engine, it's an execution engine.
Exactly.
Huh.
It acts as a proactive operational partner. It doesn't just wait passively to be asked a question. If it detects an anomaly, say a sudden spike in refunds on a specific menu item or a localized inventory shortage, it identifies the pattern and prompts the business owner to take action before a minor inefficiency becomes a massive loss.
It is essentially giving every small and mid-market business a digitized chief operating officer that works 24/7.
And management noted that the retention rate for sellers who actively engage with ManagerBot has surprised them to the upside. When a tool actually does the heavy lifting of running your business, you don't turn it off.
And then on the consumer side, they have rolled out MoneyBot within Cash App,
which is producing equally fascinating engagement metrics. They rolled MoneyBot out to general availability, and management explicitly noted that without spending a single dollar on marketing campaigns to promote it, the bot saw 1 million active users in its first week.
1 million users with 0 ad spend.
But the raw user numbers aren't even the impressive part. The crucial data point is the conversion rate. Of the customers who initiated a money movement via MoneyBot, 1/3 of them attached to a net new financial product.
Wait, let me make sure I understand the flow of that. A user opens Cash App, interacts with MoneyBot to, say, send $50 to a friend or move money into a savings vault. And during that interaction, the bot analyzes their profile and successfully cross-sells them a new product, maybe a Bitcoin purchase or setting up a direct deposit 33% of the time.
Yes. The bot acts as a highly personalized, context-aware, automated cross-selling engine.
That is the absolute holy grail of unit economics. If your AI agent is successfully doing the cross-selling organically during routine transactions, your customer acquisition costs for those new high-margin products drops to near zero.
It's massive leverage.
You don't have to buy expensive Facebook ads to convince a user to try your lending product. The bot just offers it to them at the exact moment they need it.
Right.
All right, before we move into the forward-looking guidance, there is one more critical piece of the ecosystem puzzle that was brought up during the analyst Q&A. It's a strategy that ties both of these massive platforms together, and I look at it as the missing link. The program is called Neighborhoods.
This is a vital strategic bridge that Wall Street has been demanding for years.
Because for the longest time, analysts have looked at Block and said, you have millions of merchants processing billions of dollars on Square, and you have tens of millions of consumers holding cash balances on Cash App. Why aren't these two massive networks talking to each other?
Right. Neighborhoods is the definitive answer to that question. It is designed to directly connect Square sellers with local Cash App consumers.
So how does it function mechanically for the end user?
It essentially turns Cash App into a localized discovery and commerce platform. It allows Cash App users to search for local merchants who use Square, view their inventory catalogs directly within Cash App, effectively follow those merchants for updates and promotions, and seamlessly make purchases using their Cash App balance.
They are essentially trying to build WeChat or Alipay for the Western market, a totally closed-loop economy where the money never actually leaves the Block ecosystem.
That's the vision.
A user gets their paycheck direct deposited into Cash App and then uses that exact same interface to buy a coffee from a Square merchant. Block captures the data and the margin on both sides of the transaction without ever having to route the money through a traditional external bank.
And the traction they are seeing with Neighborhoods is hockey sticking. They reported that the program recently hit $320 million in annualized gross payment volume. That figure is up 190% since just December. In the month of April alone, they added more sellers to the Neighborhoods ecosystem than they had in the product's entire prior history.
190% growth in a matter of months is exponential. But the statistic that truly illustrates the potential here is the engagement depth.
Yeah.
Management noted that the spend originating from these Cash App followers can reach about 10% of a merchant's overall GPV after just a few quarters of being on the platform.
Think about the value proposition for the merchant there. If you are a local bakery and Square comes to you and says, not only will we process your payments, but we will directly expose your business to thousands of local consumers on Cash App, and within a few quarters, we can boost your total revenue by 10% organically.
That is an offer no legacy payment processor can match. It completely changes the conversation from how cheap are your processing fees to how much new revenue can you drive for me.
They're transitioning from a utility to a growth partner.
And building that closed-loop economy sets the stage perfectly for how management is viewing the rest of the year. Let's move into Section 3, Management Guidance. Because when a company reports earnings, the historical numbers are a great report card, but Wall Street trades entirely on the future.
Always.
And Block's executive team came out with a massive beat and raise.
They didn't just nudge the numbers up. They raised their full year 2026 expectations aggressively across the board, signaling immense confidence in these new structural efficiencies.
Let's hit the upgraded outlook. They are now projecting $12.3 billion in gross profit for the full year, which represents a 19% year-over-year growth rate.
Very strong.
They expect $3.34 billion in adjusted operating income, and the EPS earnings per share is projected at $3.85, which is a massive 62% year-over-year jump.
That 62% EPS growth projection is the ultimate validation of the structural changes we've been discussing. It proves that the 56% operating income jump in Q1 wasn't a one-off accounting trick. They believe they can sustain that operating leverage, growing the bottom line exponentially faster than the top line for the entire fiscal year.
Let's zoom in on Q2 specifically, because Marita Ahuja pointed out some very specific accounting nuances that investors need to watch, particularly regarding Square's growth rates.
Right.
They expect Q2 total gross profit to hit $3.04 billion, but she spent a significant amount of time addressing the gap between Square's volume growth and profit growth.
If you recall from earlier, in Q1, Square's gross payment volume grew 13%, but its gross profit only grew 9%. Ahuja specifically noted that they expect this gap to narrow significantly in Q2.
Why did that gap exist in the first place? If a merchant processes 13% more money through the system, shouldn't Block's profit logically go up by 13%?
In a perfect vacuum, yes. But corporate finance is messy. That gap can be caused by shifting product mix, say, merchants buying lower margin hardware instead of higher margin software. It can be caused by pricing changes. But crucially, it is often distorted by one-time accounting items that artificially inflate or deflate the numbers in a given quarter.
Okay, so what were the anomalies here?
Ahuja explained that the Q1 gap was partly due to tough year-over-year comparisons. But in Q2, two specific tailwinds are going to help close that gap. First, they are lapping, meaning they are passing the one-year anniversary of a significant network remediation payment that dragged down their profit numbers in the prior year.
So the comparable baseline from last year was artificially low.
Exactly. Second, they are anticipating a one-time tariff refund related to Square hardware imports. When those one-time anomalies wash out of the system and that refund hits the books, Square's reported gross profit growth should accelerate and more closely mirror its actual underlying transaction volume growth.
It presents a much cleaner, more accurate picture of the business's actual velocity. Now, here's the part of the forward guidance that I found most telling about management's current mindset, and it revolves around reinvesting their wins.
This is a huge point.
Despite raising their margin expectations so aggressively for the year, they explicitly stated on the call that they are actively increasing their go-to-market investments in Q2.
This is a massive tell regarding the internal health of the company. When a company is struggling to find product market fit, or when their acquisition costs are spiraling out of control, they hoard cash.
Right. They cut marketing, they freeze hiring.
But Block is doing the exact opposite. They're generating record profits, and instead of just sitting on it to make the balance sheet look pretty, they're pouring it right back into the engine. Why? Because their customer acquisition unit economics are screaming at them to step on the gas.
This comes down to the LTV to CAC ratio, the lifetime value of a customer versus the customer acquisition cost. Ahuja noted that their payback periods are currently sitting at an incredibly healthy 4 to 6 quarters.
Let's translate what that actually means for the business. It means if Block spends $100 on marketing or ISO revenue shares or field sales commissions to acquire a new Square seller or a new Cash App user, they earn that initial $100 back in pure profit within 12 to 18 months.
And every dollar generated by that customer after month 18 is pure compounding margin.
Exactly. In the software and payments world, a 4 to 6 quarter payback period is top tier efficiency.
When your unit economics are that tightly calibrated, the absolutely correct strategic move is to pour maximum fuel on the fire. You spend more on targeted performance marketing, you hire more enterprise field reps, you aggressively expand the payouts for those ISO partnerships because you know with near mathematical certainty that every dollar you put into the top of the funnel is going to generate a high margin return on investment.
It's an aggressive posture, but it is a highly disciplined aggression based on data, not desperation.
And that aggressive reinvestment strategy is what gives them the confidence to raise the full year guidance so substantially. Which brings us to the culmination of this deep dive. Section 4, the bottom line. We have dissected the massive Q1 headline numbers. We have explored the structural reorganization, the maturation of Cash App into a primary bank, the expansion of the ISO network, and the highly tangible deployment of internal AI tools.
We've covered a lot of ground.
We've analyzed the upgraded 2026 guidance and the underlying unit economics. It is time to synthesize all of this data and deliver the definitive talk tickers verdict.
When you look at the totality of the evidence, the structural efficiencies proving out in the margins, the re-acceleration of deep user engagement across both platforms, and the tangible, measurable impact of their AI deployment on product velocity, our stance on Block coming out of this quarter is heavily unequivocally bullish.
I am completely aligned with that verdict. The transformation of this company over the last 12 months is undeniable. Let's distill this entire analysis down to the core actionable takeaways for the listener. The 3 fundamental pillars you need to understand if you are holding this stock or modeling its future.
Okay, let's hit them.
Takeaway number 1, the operating leverage is real.
The 56% jump in adjusted operating income on the back of 27% gross profit growth is the definitive proof of concept for Dorsey's reorganization. Block has successfully and painfully transitioned from a growth at all costs, figure out the margins later startup mentality into a mature, highly profitable financial engine. They have proven they can drastically expand their profit margins without sacrificing their product innovation or their top-line growth.
Takeaway number 2. Ecosystem lock-in is deepening. Block is no longer just a point-of-sale terminal for food trucks or a peer-to-peer app for splitting rent. With the expansion of products like Cash App Green, which drives core banking activity, and the rollout of managed accounts for kids ages 6 to 12, which is a brilliant long-term strategy for capturing the next generation of consumers before traditional banks even have a chance to market to them.
And don't forget neighborhoods.
Right. And the rapid scaling of the Neighborhoods program connecting buyers and sellers directly. Block is capturing entire financial life cycles. They are weaving an interlocking web of services that makes it incredibly hard and, frankly, highly inconvenient for a user to ever leave their ecosystem.
And takeaway number 3, artificial intelligence as a tangible moat. Every company is talking about AI, but Block brought receipts. They aren't just bolting a generic chatbot onto their website for public relations. They are deploying custom LLMs to fundamentally lower the cost of software development.
Which is a massive competitive advantage.
When 2 engineers can build in 3 weeks what historically required 6 engineers in 3 months, that creates a structural cost advantage that competitors who lack that sophisticated internal tooling simply cannot replicate. It allows Block to iterate faster, ship more features, and service more complex clients cheaper than almost anyone else in the fintech space.
But, as always on this show, we refuse to just wear rose-colored glasses and read the corporate PR script. We have to look at the bear case. We have to identify the friction points. What is the primary risk factor that investors need to aggressively monitor in the coming quarters?
The primary headwind, which management was transparent about on the call, revolves around the borrow feature within Cash App. Borrow has been a massive high-margin driver of their recent growth, accounting for over half of Cash App's expansion in recent quarters. However, management explicitly stated they expect the hypergrowth of this specific feature to normalize and slow down in the back half of 2026.
It's the simple law of large numbers. You cannot double the size of an unsecured consumer loan portfolio every single year forever without eventually taking on toxic subprime risk. At some point, the pool of responsible borrowers caps out.
Exactly. They are going to start lapping the exceptional growth rates they saw when they first scaled the product. So, the primary risk for investors holding the stock is an execution risk.
Yeah.
Can Block's new initiatives spin up fast enough to fill that specific growth gap?
You need to monitor the Q3 and Q4 metrics to see if the new pre-purchase buy now pay later toggles, the massive 35% growth in international expansion, and the scaling of those 140 ISO partner sales can generate enough net new volume to offset the mathematical normalization of the borrow product.
If those new engines fire as designed, and the unit economics hold steady at a 4 to 6 quarter payback period, the bullish thesis remains incredibly strong.
All right, that wraps up our expansive deep dive into Block's Q1 2026 performance. We have stripped the numbers down to the studs and rebuilt the narrative based purely on the data. But before we sign off, we always like to leave you with a macro thought to chew on, something that stretches beyond the quarterly spreadsheet.
And the final thought to take away from these sources comes directly from a highly philosophical vision Jack Dorsey laid out during the Q&A segment. He stated quite plainly that Block is actively evolving from an app company into an intelligence company. He pointed toward a near future dominated by what he called agentic commerce.
Agentic commerce. It sounds like something out of a sci-fi novel. But based on what we just discussed with ManagerBot and MoneyBot, it is rapidly becoming a reality.
He laid out a very practical, highly disruptive use case. Imagine a future where AI agents, the evolution of ManagerBot, are not just advising merchants, but automatically executing complex operations.
Like what?
Imagine an AI agent autonomously purchasing inventory from external vendors based on real-time integrations of sales data, local weather patterns predicting foot traffic, and global supply chain fluctuations, completely without human intervention or approval.
So the local coffee shop's AI system realizes they are going to run out of oat milk by 2 p.m. on a Tuesday because a convention is in town, and it automatically negotiates pricing and orders more from the supplier's AI system on Monday night.
Precisely. The systems negotiate with each other. If Block successfully deploys these autonomous AI agents to run the mundane operations of millions of mid-market businesses and eventually manages individual consumer bank accounts via advanced iterations of MoneyBot, it raises a profound, industry-altering question. Are we currently looking at the beginning of the end for traditional user interfaces?
It's a staggering thought. In 5 years, will a small business owner even need to open a dashboard, scroll through analytics menus, and manually click buttons to order supplies? Will a consumer ever need to log into a banking app to manually allocate funds to savings or pay a bill? Or will your money and the entire operational back end of your business simply manage itself in the background, governed silently by an intelligence engine you have learned to trust?
It fundamentally changes what a financial company actually sells. You are no longer selling software. You are selling peace of mind and time automation.
It brings us right back to the core premise of this deep dive. When you look at Block today and you see 56% operating income growth and 2.5x engineering productivity, you aren't just looking at the bones of a payment processor. If you look closely enough at the data, you can see the intelligence starting to pulse through the system, acting on its own. The real question for investors is, how big will that intelligence grow before the rest of the market catches on? Something to think about until next time.